I've been working in this field for a good 5 to 10 years now, around this question of environmental social governance data and how it is formulated by companies, how it is then reported to others, and particularly how it is reported to investors as part of the financial report. And what Dan and I have found through our research is that we have a lot of methodological issues with the data that is being generated by corporations today. This includes lack of verification. It includes differences in the way that data is collected by corporations, differences in how it's reported, and generally it creates a lack of faith by investors in the quality of that data. It's very difficult to make investment decisions if you don't believe what the data is telling you because you don't believe in the data itself. And there are a number of initiatives and efforts going on today to try and improve the quality of that data, but those efforts are still underway. So we have a fundamental challenge still on the methodological quality of data. The second challenge is around the application of the data. In particular, we have challenges in the scope and the boundary of corporate data that is produced. So one company, for example, might produce Scope 1 and Scope 2 greenhouse gas emissions, whereas another company might be reporting Scope 3 emissions. And it can be very difficult for investors to tease out those different scopes. We see similar challenges in boundary, where one company might include all of its operations, another company might only include operations in, say, the United States and Europe. And again, it can be difficult to tease out these differences in boundaries. And this makes overall the challenge of finding comparable data where I can say that company A is performing significantly or meaningfully different than company B. The last challenge that I want to focus on today is around materiality and how data is moved from an environmental social governance voluntary report, like a sustainability report, into a financial report. And there are a number of issues that in crossing that gap or moving between these different disclosures. So one of the issues that we've been studying most recently in partnership with GRI and the World Business Council for Sustainable Development and Ceres and others focuses on the process by which a company will assess environmental and social information in order to put it into a financial report. Or in other words, if I have an environmental aspect, an environmental issue, how do I decide that it is material enough to disclose to investors, as opposed to disclosing it to a broader set of stakeholders through a voluntary report? And this has implications. To move data into a financial report, especially into the financial statements of a report, has legal implications, it has investor and financial implications, and so this is an important decision, and one that companies have been reluctant to be on the forefront of. There's relatively little reference to a standard for reporting and disclosure and materiality outside of sustainability reports. In sustainability reports, we see reference to primarily the Global Reporting Initiative standard. The GRI standard was referenced by almost half of the companies that we looked at, and then a minority were looking at other standards, such as the Sustainability Accounting Standards Board, particularly U.S. companies, and some others. But when you go to the financial report, there's almost no standard referenced. And that's because there are very few standards that are recognized by the financial community in the ESG space. So between the lack of transparency, a lack of standardization, and a lack of comparability in the data, we have real issues in figuring out how we're going to move from where we are today, where there's this enormous gap, to where we need to be tomorrow, which is investors that have decision-useful information that they can use.